Morning, everyone. Nice to see you all. I'm sorry it's November in London and not Cape Town in December as usual, but we can't promise the weather, I'm afraid. But it is nice to be in person, so slowly we'll get back into normal life. My name is Nigel Wellings. I'm a partner and co-head of the London corporate practice at Clifford, and I'm the leader of our African private equity team, so delighted to be here. I have with me today a great panel. We have Yemi, Lars and Hatim from the respective organisations, TPG, DEG Impact and Mediterrania, and I'm sure those organisations are well known to you. So we are going to crack straight on, if we may. How is the private equity market truly doing? We don't need to go back over the difficulties of the last year and a half. Obviously, a lot of funds will have been focusing on their asset and portfolio management. So what we want to move on to is a bit of the future. But to start, perhaps, and we're going to sort of split it quite simply into the fundraising side and the transactional side. So we'll start with maybe Lars, if we could start with you as the LP perspective. What do you think the future is, or the current outlook for fundraising in Africa at the moment?
I mean, obviously it's quite difficult, and COVID didn't help. It was difficult to travel, so it was difficult to do due diligence. So I think there was a clear trend for LPs to go rather with GPs that you know, and rather put a bigger ticket into a GP that you know, instead of finding a new first-time team, due diligence on the ground. So that makes it really difficult. Or you just said, okay, let's wait for it and go next year or something. So it's definitely a bit difficult, yeah.
And have you therefore, just on that, the go next year, is that delay been a thing you've really seen and been pushing for, or just accepting, Lars? Do you think that delay has been?
Question for Lars?
Lars, yeah, just from your perspective, that delay been something you've welcomed or just expected?
Me myself, no. I think normally it's a good time for investments, right? Because if everything is down, then you should invest now, and then it would be a good vintage, I'm sure. But obviously it's extremely difficult to convince either your credit committee or private investors. It's almost impossible because they say no one knows what's going to happen, and Africa is even more difficult, so not doing it. Although I think Africa isn't hit as hard as other continents, so it's rather stable because they consume what they consume anyway, and they're not so dependent on export like Europe is. So I think it would be a good timing, but obviously it's not.
And well, it's good to hear the DFIs are supportive. Hatim, you've been in the market fundraising, I understand. Do you just want to give your perspective?
Thank you, Nigel. I guess, look, the ingredients that LPs were looking before COVID-19 are the same today. I mean, the consistent team, a track record, ability to generate deal flow, and ability to generate exits. That hasn't changed. I think maybe currently LPs are putting maybe more closer look to our ability to manage portfolio. I think during 2020 we all spent a lot of time on handling our portfolio and navigate through the crisis. And I think our LPs are looking at that closely. And it's somehow it is a way to put our portfolio into a test. That's what COVID-19 was for us. And I think in most assets, our portfolio companies managed to rebound in 2021, and I think LP sees that. So I guess somehow it is not, I would say, as similar as before the crisis, but it is not far away from that. I mean, that's the way we experience things and discussion with our LPs. Maybe one thing which is more difficult now than before is our ability, us as a GP, to expand geographically and maybe drift in terms of investment strategy. Before we were able to add new geographies to our investment mandate. I guess that now is not the time for that. I think it's a time for to give to our LPs consistency and stability in our investment mandates, for them to be able to, as Lars says, go and take a swifter decisions in their credit committees. But all in all, I see that most LPs we're discussing with right now are still looking at investment opportunities in the regions, things that they will close in 2022. And I remain highly optimistic about that, I guess.
Okay, so you're saying that. So how would you characterize the conversations you've had to have as being very different to what they were 3-4 years ago, or sort of quite similar but just nuanced in a different way?
No, I think they were, as I said, closer look to the portfolio, how the portfolio has rebounded in 2021, closer look at our ability to access deal flow, questioning that, and us having some local offices has helped that, I guess. But conversation is not drastically different than before. That's my guess. But also, we're trying to reduce, I would say, all the risks by sticking to our investment mandate and same investment strategy than before, which is gross capital. So we try to reduce, the level of risk for our LPs. But all in all, yes, conversations are very similar than before.
Okay, that's interesting. And Yemi, from one thing we were touching on as we were discussing this is that there's definitely been a feature of the market recently. There's been some consolidation in the GP market. I mean, what's your view of that generally?
Yeah, excuse me. I think it's actually quite good for the market. You know, my view has always been that we haven't had a problem of too much money in Africa, but at some level maybe we had too many managers. It's quite important at the GP level to have enough scale to be able to work with the portfolio companies, add value to the portfolio companies. You also need to have a critical mass of talent, frankly, within the firm. So having a firm where you have just one experienced GP and everybody else is doing it for the first time is not as good as having one where you have 5 experienced GPs who are working together to do investments. So I think it's healthy for the market long term. Now, the thing that gets a little bit tricky with that, though, is that from the LP perspective, so for Lars and his colleagues, it's still important to fund first-time managers. But the first-time managers have to be coming to the market with something that is unique and different. Right? So saying you're going to do a first-time fund that is a generalist fund, doing deals in Nigeria and Kenya and some of the big markets, I think it's going to be quite difficult to get those funded in an environment where you're starting to get consolidation of GPs and a little bit of a flight to quality in a sense. So I think for the new managers coming on board, there's going to need to be a lot of innovation in terms of the business models they're going after and what exactly they're trying to do that is different versus more of the same.
Okay. And Lars, what do you think of that?
Obviously, I'm a bit of a different opinion, so I think it's not too healthy to have like only a few GPs that get all the money. Although I understand that you or Hatim would like it. So I think you need new talents, new smaller GPs, new creative GPs, and not only the ones that are there for a couple of years are getting a bit tired because it's too easy to raise money. And so I think it's the opposite.
It's too easy to raise money.
I would say that.
It's never easy to raise money.
It should be really that some young talents come up as well, and then especially in the VC, we're going to talk about that as well, or in climate change or whatever it is. So in the niche market, I agree that if you're now a first-time fund manager raising an opportunistic fund in Nigeria, you probably will not succeed. But if you're creative and you have a special angle, then it is possible. And I think there's now a new trend as well to open new markets. And I think it's very important for the continent because it has to become creative. And
but just if I could just add to that, actually, I don't think Lars and I, unfortunately, are not really disagreeing. The one sector where this is obviously quite different and where I think consolidation is a negative is in the early stage VC space, right? Because by definition, given the nature of the funnel for venture capital investments, you need to have dozens of funds, frankly, out there doing seed investments, given that only a small percentage are going to make it through at the end of the day. So the dynamic there is completely different. You don't want to have somebody running, frankly, a $500 million seed stage fund. It doesn't make any sense. So those are smaller funds, more focused, and there I don't think you'll see the consolidation.
Okay. But is the other element of consolidation that might be useful is to produce some more larger scale funds at the current time? Do you think that's a potentially positive?
I mean, it could. I think you need the entire spectrum of everything, like the small ones, the big ones, and the really huge ones. But unfortunately, what we can see right now in Africa is that a lot of like big established players are pulling out of Africa, right? I mean, there's DPI still that has raised a big fund, but the other big names, Carla, etc., they are just not there anymore and just pull out of Africa, and that's a bit, worrying me actually, because you need the spectrum so that the small funds can sell and that there's a secondary market, etc., but I don't see it right now.
Yeah, I think that's fair. That's certainly been a factor. And just, we also touched on, the idea of whether the secondaries market, and obviously just meaning that, LP interests being bought and sold might be a factor in that. I mean, obviously that's something that's come into the European and the US markets, but do you see a role for that in Africa?
I mean, unfortunately, we don't see a secondary market, so I think we would need it, but it's just not there. And I think, if I can talk for other DFIs as well, there would be a great role for DFIs supporting first-time teams, and then once they are established, then sell them on the secondary market, even with a small discount. But it's just not there, so it doesn't work. So you're always stuck with your portfolio for 10, 15 years, and that doesn't really accelerate the process. That's a problem.
Yeah, okay. I mean, it's interesting, isn't it? Because you would have thought that, we'll come on to the length of time for exits in a moment, but you'd have thought the secondaries market is a natural solution to that. So it's interesting that it hasn't developed. So I think actually moving on to exits, obviously there was a clear slowdown in 2020. You mentioned as simple, travel and other things being difficult. So I think our sense was that there'd been quite a long rebound this year, quite a strong rebound. But Lars, I mean, what's your, that delay, which is now sort of baked in, if you like, to the funds, what's your view of the impact? And as we're coming back to the question, in terms of how the market's really doing, what impact will that delay have had in your view?
I mean, there's not necessarily delay. There have happened some exits, so really good deals are still interested, and you still can sell them. I like to tease my fellow GP partners here and say it's just another excuse they have to delay another exit. But obviously it didn't help, right? So I think it will eat some IRR, obviously, and but still, as I said, the good deals will be sold and the bad deals will not be sold. So I think it didn't really change something. It's probably a delay of a year, but it could also be seen positively, because if you look at Africa, there's always something, right? There's a devaluation, there's a revolution, there's a civil war. So COVID actually is not as bad as a revolution in Egypt, for example, right? So they say it's rather have another COVID than have a revolution where nothing goes and the devaluation is 50%. So it's not too bad.
Okay, good. It's not too bad. Hatim, what's your experience been on the exit side?
Look, I agree with Lars. In the sense that Lars is no more an LP of mine. I agree with Lars in the sense that again, exit has always been one of our main challenges in Africa in terms of us as GP, and COVID hasn't made that more easy nor more difficult. Lars is right in the sense that it's most GP we had to pause in 2020 to focus on portfolio. Of course, some of us had exits in 2020, engaged in 2019. Most of us, we've paused a bit in 2020 to look at our portfolio, but then it was obvious to us in most markets where we operate that the COVID-19 pandemic will not have a drastic change, will not have drastic changes in business models, at least in most business models, if you exclude some real estate investment. But in most business models, COVID-19 didn't have a huge impact. So when you look at the performance of portfolio in 2021, most GPs, we were back on the exit mode this year. All discussion we've had before the COVID have started again in 2021. And the reason behind that is that the intrinsic value of most assets hasn't changed in 2020. Maybe the way to look at pricing has changed, and based on 2021 performance, but the value of the asset hasn't changed. So therefore, I think, at least for us, we are looking at exits, and I know that other fellows GPs as well. I guess 2022 should be a year where you will see a significant liquidity back to LPs, and I think Lars will be happy about that. Maybe one thing we have done is to reschedule some exits, based on the 2020 performance and the way the companies have rebounded in 2021. Some of them might need a bit more time, so we have looked at rescheduling some exits. But all in all, I guess we are almost, like fundraising, almost in a similar situation than before the crisis.
And do you think, and when you've looked at the buyer universe for those exits or the exit options, are you seeing anything different, or do you think it is not
No, I mean,
changed?
people we're talking to are very pragmatic. Whether it's another GP or it's a strategic, people are very pragmatic. I mean, they see that when you were having a trend of growth 2018, 19, and we see a drop in 2020 and then rebound in 2021, I mean, people are very pragmatic and understand the underlying value of the assets. We didn't have anyone that came to us and said, I'm paying you at a discount right now. I mean, people are looking at how we performed this year, might be looking as well at how we perform first quarter next year. But overall, I guess buyers are pragmatic. A good asset before the COVID is still a good asset today. And that's the way we see things happening on the ground.
Okay, good. Yemi, anything to add to that?
Yeah, I'm actually more excited about the exit prospects for African private equity today than at any time, since I started investing on the continent more than a decade ago. Because what we're starting to see is a lot more interest from international investors. Over the past 2 years, we've seen IPOs in London and in New York. Obviously, Cairo has just been on a tear. In terms of exit opportunities for companies. So the old story around not being able to take African companies public in international markets, I think that's been disproven. We have enough data points now to show that we can actually do that. So that's quite exciting. We see strategics coming in as well. Now, I guess it's fair to say, though, that a lot of that activity is within certain sectors or technology, TMT related, let's just broadly call it that. But there's a lot of excitement around that. For the more traditional businesses, the real economy businesses, so to speak, we don't see the same level of enthusiasm from investors, which interestingly is now led into this dynamic where I guess everybody's becoming a tech investor in Africa these days. For those of us who've been doing it for a couple of decades, we find it quite amusing, and at some level, I guess it's encouraging that people are seeing technology as a driver of growth. But at the end of the day, the challenges we've had on the continent are really around the things Lars mentioned, right? So there's always something. So the currency goes, and there's some civil disturbance, and so on and so forth. And the way to work through that, I mean, there's no way you can actually hedge the currency. So the only way you can work through that and end up with a good return is with a high growth business. Right? It's still painful, and so an 8x maybe becomes a 5x, but it's still a 5x. So you can see why naturally people would gravitate to sectors where you can deliver that sort of growth. But overall, if I just look at where we are today compared to where we were even 5 years ago, and the sort of case studies that we can put out there of exits that have happened successfully, I think we're in a really good place.
Yeah, and the point you make about the IPOs is a very good one. I think has been a positive. IHS being the most obvious example. Yeah. But in terms of enthusiasm, and you just touched on tech, and you touched on VC earlier. I mean, what do you think the sort of the growth in that area might do more generally for the market? It's sort of an interesting thing, and I guess at some level, one can look at it in a couple of different ways. The first thing is, anytime people want to put money in Africa, I'm happy. Right? Now the question is whether the money is coming in at the sort of valuations that will deliver returns down the road. Obviously, that remains to be seen, right? And time will tell over the next few years. But there's certainly a lot of excitement about what's happening on the continent. Plenty of first-time investors coming in, leading deals, and doing all of that. That's all fantastic. But for me, the thing that is even most interesting is, as we know, economies are just not generating jobs. I mean, that's just a fact. Right? 25, 30% unemployment rates, and entrepreneurship is the only way out of this. I just don't see any other way. Unfortunately, the cost of operating in Africa is just too high. Very few, other than Ethiopia,
There are very few African countries that can compete with Vietnam, for example, right? Like Nigeria is way more expensive than Vietnam. You're not going to move manufacturing from Vietnam to Nigeria. It makes absolutely no sense. So if we're not going to be able to then pursue the path that was pursued by some of the faster growing Asian economies, then what do we do, given that? And the ability of people to build their own businesses and generate jobs, as we've seen with many of these companies, you know, the Flutterwaves of the world and so on and so forth, I just think is critically important. Otherwise, we're in a lot of trouble, frankly, because the real economy is just not going to generate the jobs.
Okay, interesting. And in terms of other, I mean, what other drivers do you think there might be that are positive for the market at the moment? I mean, obviously we've got COP26 going on, everyone's talking about ESG. Africa's always been somewhere there where impact and ESG have been important. Do we think that, and perhaps Yemi or Lars, or in fact, either, any of you could comment on this, do you think that new focus or the broader focus on ESG is a positive or neutral or negative for our market? Lars?
I think it can be both. So I'm a bit afraid that it could be like inflated by everyone saying ESG and it's everywhere. And we talked before about it. If it's not offshore drilling, then everything is impact and everything is ESG. And so that if you come up with a good proposal in Africa and say, look, it's a big ESG impact, no one believes you anymore because everything is ESG. So that's a bit of the risk. But obviously this is a role that Africa can play, and it has been always more important than for other continents. So I think they can be a front runner there, and that could be positive as well.
Okay. And Hatim, have you changed the way? Have you sort of recalibrated how you position your ESG, or is it still, a core value and you're doing it the same way?
It has always been for us a core value. I agree with Lars, but I mean, in our opinion, impact is a very wide word that. Lars is right, you can put it in that everything you want, but the reality is that every time us GP we do a transaction in Africa, we create jobs. We increase the amount of local taxes paid. All our companies generate more social protection to the employees, and so on and so on and so on. So overall, I guess throughout our GP community, we are all very proud that every single transaction we do generate an impact. Of course. The way we look at it when investing, we always encompass ESG component in it. So we look at ESG before investing, of course. But one thing is for sure, when you look at 3 or 4 years ownership from a PE fund, you will always find some sort of an impact, and the magnitude of it will depend. But I guess impact is always present when we invest.
And Yemi, your views, obviously.
Yeah, I think it's probably net negative, frankly, for African private equity, for the very simple reason that as impact investing becomes more and more of an asset class, so to speak, on its own, for those GPs who had to, LPs, so international LPs, and the DFIs are different, right? So ex-DFIs, so the international LPs who sort of had to invest in Africa if they wanted to get impact investments done, now they don't have to do that. They can invest in Bain Capital Impact that only does US deals.
Right.
And they can make their impact allocation that way, in a sense. So they're going to have many more options. I hope it's neutral, but I suspect it'll be net negative actually, right? You can invest in KKR's Global Impact Fund. You can invest in our Global Impact Funds and get all of that exposure. I mean, at least if you invest in ours, at least you'll get some Africa, which you might not get with some of the others. But for a big LP that wants to do a $100 million commitment, it's just much easier to invest in KKR's Global Impact Fund and to try to find a couple of African managers to help you meet your impact sort of allocation. So I'm afraid it might end up actually being net negative.
And so do you think there's anything that our market, the GPs, the LPs in it can do to try and drive that negative up to at least a neutral, or just change that perception?
Well, I think we just get back to the fundamentals, right? Because the thing that is different about the approach to impact investing, certainly our approach to it, is that we absolutely do not see that there should be any trade-off between impact and returns. Right? So the LPs, of course, are going to be thinking that way. Like historically, it wasn't like that, right? So people sort of impact. Okay, fine. I'll take a little bit of a discount on the economics. But so if you're thinking that way, then interestingly, you just go back to first principles. What do the returns look like, right? Because I can now get impact in Asia, I can get it in Latin America, I can get it in the US, I can get it in Europe. And the question is, how do the returns compare at the end of the day? Like African impact isn't more valuable than impact in Oakland, California.
Yep.
Fundamentally, right? So impact is impact as long as you're consistent in terms of how you measure it. So then it just boils down to returns.
It all comes back to returns.
It always does.
We've got a few minutes left. Do we have any questions from anyone? Oh, at the front.
Hi everyone. It's a comment about impact and return.
Oh, there's a
Hi everyone. Impact and return. Quite often we hear comment as if impact can be achieved at the expense of return. Isn't it the case that actually impact can be achieved generating super return? Because if we align people, align all stakeholders, just inspire people to be their best version, doing what is good for society, in my view, it's just so empowering.
Well, I can't argue with that. That is clearly
true.
But do we want to just explore that link between the definition of impact and the return?
Yeah, look, I'm happy to take it. I mean, for us, it's quite fundamental to what we do. And perhaps the big difference between our approach and sort of the tourism, that growth investment is always impactful, which of course it is, right? We're not doing slash and burn buyout deals in Africa. So the stuff we do is impactful anyway. The big difference is really the intentionality and the fact that we're looking for what we call collinearity, which means that the business has to be such that the business performance increases, the impact increases. So it can be a sideshow. So it can be that I'm running a big farm in Ethiopia and I set up hospitals and schools and all that, which is fantastic for the community, but it has nothing to do with your business. That's the fact of the matter. It's just a nice thing you're doing on the side. So it just has to be tied to the business, so there's no conflict at all. Business gets better, impact increases. So that's the difference. Really, is just being intentional about how you think about it, and obviously how you measure it.
No, I think that final point is really interesting, tying it into the business, because there has been, I think, a previous model, as you say, which is we'll do what we like here, but we'll just put some money
some other good stuff on the side, right? Yeah.
Lars, anything to add, or you?
I mean, probably you can turn it around, and then you can't invest without impact, right? So if you really do something that has no impact at all, then you shouldn't invest. That's probably the other way. But I absolutely agree with you. It's empowering.
One more question.
Hi guys, thanks. It's been a really interesting panel. One of the comments you made was around kind of the secondary market, the challenges around creating the exits. Perhaps just a general question to the panelists around what do you think can be done to kind of create a more robust secondary ecosystem for African PE?
Who'd like to take that?
Well, I guess I can try to address that. I think when we mentioned earlier secondaries, we were talking of it, I think, at the LP level, but I guess your question is more at the portfolios level. And I think in here, one of our key issue on the continent is that, and here I slightly disagree with Yemi, I think we do not have enough GPs operating that would be able to animate a strong secondary market. I think that when you look at what is happening in Europe, I guess half of PE transactions are secondary transactions among GPs. I think in our part of the world, we do not have yet that dynamism. It is happening, it's starting. We are discussing more and more among other GPs about looking at each other's portfolios and good assets. However, it is not as dynamic as it should be. So I guess one piece of the equation will be to be able to allow more GPs to enter the market, and I think that is circling back to the first-time fund managers that Lars was mentioning. Might not be the right year for that, but I guess at some point that will have to happen. I don't know.
Anything to add?
No.
Well, we're coming up to time. I mean, I think I can't see anyone from DPI in the room, but you know, perhaps 900 million will drive the secondary market over the next year that they've just raised. So we perhaps need to ask DPI later today whether they're going to create the secondaries market. But thank you very much, Lars, Yemi, and Hatim. Thank you.